In this video with Andrew Robinson, market analyst for Saxo Capital Markets in Singapore, he takes a look at the challenges for China's economy in this final quarter, with the official growth target under pressure and the pending political handover clouding the possibility of further stimulus measures before next year. Welcome, Andrew.
Hello again.
China's latest growth figures released for the July to September period showed that the world's second largest economy is struggling. The economy grew at 7.4%, which is below the Chinese authorities' goal for annual growth for this year of 7.5%. What are the main areas of concern growth-wise in the latest data?
Well, I think generally the numbers were not too far from what the market was expecting. The sentiment after the data seems to be quite positive. So the actual 7.4% growth, even though it is 0.1% below the official numbers, is not seen to be so much of an issue. What we did see in the accompanying statement from the National Bureau of Statistics, they were saying that maybe a bit of caution is required, that the consolidation of the Chinese economy is not necessarily on that solid of a footing. So they're slightly cautious. They're also a bit cautious about inflation. They're saying that the weakness or the money that's being pumped into the global economy could force global inflation issues, and they do recognise that the Chinese economy is still subject to these inflationary pressures. So concerns regarding growth, I think, are not there. It's more a concern about the inflation side.
And with just a few months left to the year, what, if anything, can the Chinese authorities do otherwise to ensure that its growth target is met, but meanwhile inflation doesn't rear an ugly front or an ugly head, if you like?
Well, I think generally, if you look at the year-to-date numbers for the first 9 months of the year, we're actually growing at 7.7% year on year. So that's above the official target. So I think there's a growing sentiment that maybe the Chinese authorities don't need to do anything further. The stimulus measures are slowly but surely filtering through into the economy, and that they have done enough to allow a bottoming or at least a turnaround in the economy.
But the People's Bank of China does have some room for introducing more stimulus measures if needed, as proven by the latest moderate CPI increase of 1.9% in September. But in light of what we've just discussed, is any action likely then?
I think the arguments for additional stimulus maybe are being eroded as the data comes in. Like I said, we are at 7.7% year to date, so there might not necessarily be any need for further stimulus. So I think generally, it's generally the markets are probably erring to the side of maybe nothing is needed.
And what about the roadblock otherwise to doing anything policy-wise, stimulus in China because of the handover of the Chinese Communist Party Congress, which will occur mid-November? Is this a major focus right now in China?
Well, certainly as we approach the handover period, there is a period of inaction, you might say. Mr. Wen, who's leaving, certainly would not to be passing a lame duck across to his future counterpart. So I think he's quietly confident that targets will be met and that the economy at the end of the year will be better looking than it is at the moment. So generally, I think yes, there's a risk that they reach this stalemate where nothing will happen until the new guys take over the reins. But generally, I think Mr. Wen is positive that he's done enough to at least find a bottom for the Chinese economy.
What about latest retail sales figures? Do they tell us anything about Chinese consumption playing a greater role in growth?
Well, the headline numbers look pretty strong, 14.2% year on year, and on an annualized basis to year to date, we're running at 14.1%, which don't look particularly shabby. I think there is possibly an issue, the fact that the Golden Week holidays were the very first week of October, and so we might have seen excessive spending in the run-up to that. So that might have skewed the data for September just a little bit. But generally, I think the authorities are seeing that the easing and the liquidity injections that they're doing is slowly filtering through to the consumer. They are proving to be relatively resilient, but we have to remember that compared to 10 years ago, the domestic consumption is still lower as a contributor to GDP than it was then. So there's still a bit more work to be done on that front.
And how is dollar renminbi faring in all this?
Well, we've had quite a significant move, actually. The dollar renminbi is down 4.5 big figures in the last week. There's been a few theories about what's happening. Number one is possibly the fact that the US election is pending, and with all these issues about labeling China as a currency manipulator, that maybe that's one of the factors that is enticing the PBOC to refrain from intervening. I think also people are saying that some of the tail risks for the Chinese economy have been removed, or are certainly diminishing, and so we're seeing a lot of domestic onshore US dollar selling, and as a result, with pressure on the currency, and as I say, the PBOC maybe is just willing to stand back and let it fall. So there's maybe a conspiracy theory, maybe just a technical feature there, but it has been quite a significant mover over the last week.
Thanks for your insights into the Asian region this week, Andrew.
You're welcome.